Securities offered through Cambridge Investment Research Incorporated, the broker-dealer, member FINRA, SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Clear Vista Financial are not affiliated. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions.
Well, Isaiah 41:10 says, "Don't be afraid, for I am with you. Don't be discouraged, for I am your God. I will strengthen you and help you. I will hold you up with my victorious right hand." Hi, I'm Certified Kingdom Advisor Mark Trice, and I want to welcome you to the Spend Life Well show, where we apply biblical wisdom to your financial life. You can call us anytime here in the studio at 254-282-0495. You can also send us an email anytime of the week at radio@spendlifewell.com. That's radio@spendlifewell.com. And we'll respond to you either on the show or within 24 hours. And we may even choose to pull that question out of our mailbag that we get from listeners all the time and discuss it on the show. Well, folks, I'm joined in the studio today by my co-host and fellow financial professional, Jesse Hamilton.
Hey, everybody. Welcome to the show. Welcome to the Spend Life Well show. Once again, you can call us at that number 254-282-0495. And that email address, if you want to send us some email, is radio@spendlifewell.com. We'll respond to you within 24 hours of the show, and we may even choose to respond to your question on the show in the future, as Mark said. But one special thing that I wanted to bring to the attention of the listeners, Mark, is right after this show, we're having our monthly market update webinar.
Yeah, big event. People are wondering what the heck's going on with the markets.
Yes, they are. So we still have a few seats available for that. You can go to our website, spendlifewell.com/events. That is spendlifewell.com/events. And you can log in after the show. You can reserve your spot, and you could watch on a mobile device or on your computer, whatever is easiest for you. But we're going to take a deep dive into what's been happening in the markets and maybe how it could apply to your portfolio.
And this is an interactive webinar, right? Where participants can ask questions about the economy, maybe a part of their portfolio. And, you can do that and participate in that by going to Spend Life Well. That's spendlifewell.com/events. And if you can't make it, you may be driving around, you can go ahead and pull over and safely register on your phone, and you can listen to it next week when we'll send it out to all participants that had signed up. So,
we try to make that webinar approachable for everybody. We'll do an economic update without getting too technical, but we'll dive into some real numbers and dollars and cents about the markets and the economy, what's happening right now.
Excellent. Well, folks, it's been, we had winter arrive this past week with a little cold front. The highs were maybe only in the upper 80s, low 90s. And it was a little bit of a little nip in the air in the morning. So grab yourself a cup of coffee, join us, and we thank you for listening to the Spend Life Well show. Well, Jesse, hey, it's been the last 10 days or so. It's been a big news week.
Yes, they have lots of stuff happening.
So what's the big event or big announcement in the last couple of days or last week?
Well, about last week, maybe 10 days or so, if you tuned in to hear Jerome Powell speak on the decision of the Federal Reserve.
Jerome, what do you have to say?
So Jay Powell decided, along with his team, to raise the Federal Reserve interest rate by 0.75. So that was an expected raise.
Not a surprise there.
No, everybody expected that to happen, but
all the voting members of the Federal Reserve all voted unanimously to raise interest rate, and that sometimes happens, but it's kind of rare that happens. That all of them agreed on the 0.75% increase.
And one of the few times he was pretty clear was last month at Jackson Hole. He made his intentions pretty clear. And this month, sure enough, we saw follow through on what he was saying.
Yeah, the markets didn't like what he said at Jackson Hole. That the markets had been going up on anticipation that the Fed would capitulate and pivot
Hmm.
on their interest rate hikes and make an announcement that they'd be cutting rates sometime soon. And at Jackson Hole, in his speech, he said, "We are very committed." And in fact, he may have used the word very twice, very, very committed. And the markets went down
Hmm.
precipitously over the next several weeks. And since the Fed announcement, even before the Fed announcement this past week, the market, the S&P 500, has gone down in 7 days in a row, and that's
Hmm.
kind of unprecedented. That hasn't happened since the pandemic was observed, and we were alerted to that back in February, March of 2020.
Right.
So,
Well, the Federal Reserve's intentions with these rate hikes is to calm down the quote sky high inflation that we're dealing with right now. We spent an entire episode a few weeks ago talking about the realities of that inflation, but right after that comment, Jerome Powell said in an interview, we have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. I feel like Jerome Powell when I say that, because that's a very uh,
it's very,
characteristic of him.
very
But
economist-oriented
right,
statement there, and
well,
and he signaled that there are more hikes to come, more
hmm,
hikes to come. A lot of people are thinking, where's the end? Is there an end in sight
hmm.
for that? But what was
So
something else that Jerome told the reporters about expecting rates raises throughout the rest of the year and really into next year?
well, he said several things about that. But before we move on, could you tell us exactly what he means by price stability? A lot of people don't necessarily know what that means.
Well, I think he's looking at more of, are we seeing the inflationary rates and the core inflation? We're seeing that kind of taming itself.
Hmm.
We had food costs year over year with August data show that was up over 13%.
Right.
That's really, and that's impacting our pocketbooks right now. That impacts us when we go to the grocery store
Hmm.
later today or this weekend or next week. We see that, and even though we've seen the cost of energy going down, it's primarily been gasoline because we haven't been using as much of it. We had some research that we shared on a previous show that the impact of the president's releasing oil from the strategic oil reserves, which, by the way, they said they're going to continue through the November elections. I'm not sure why that's significant to them, but anyway, um, that it really has an impact on the price of a gallon of about anywhere between 13 and 30 cents. The rest, folks, is you all doing it. It's our listeners who may be driving right now. You're not driving as much. You're not spending as much money on gasoline.
Right.
But other than that, we're seeing that core inflation continue to go up. Now,
Okay.
here we are, the 1st of October. We've still got to wait a week or so before we get, inflation data for September. We may be seeing it plateauing, but when he's talking about price stability, we're talking about inflation not continuing to go up and overall year over year inflation to go down.
Hmm.
And what is that? What is that target rate for them? And that's
Okay.
2%. That's what
Right.
they've always broadcasted.
Got a
So
long ways to go.
so Uncle
So
Jerome said,
so back to your question there. The reporter was asking, is there an end in sight? And so here's my Jerome Powell response quote. He said, restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done.
yeah. So, that decision last week raised the federal funds rate between 3 and 3.25. We expect it'll be 4% by the end of the year. So maybe there's
Hmm.
another 1 to 1.25% increases over the last two meetings. They'll meet again in November. They'll also meet in December. And, that day that was announced last week, stocks fell. The S&P fell about 1.7%, NASDAQ about 1.8%, and so on. And, investors are really trying to figure out, Jesse, what's going to be happening. What is the Fed going to do from here?
Right.
So we've now had, 3 Fed meetings in a row where we've had a 0.75 percentage point increase.
Yes, that shows how significant that they are, or how serious they are about it.
But I think, the Fed is really getting much more hawkish, meaning that they think they're going to have to do a lot more to
Right.
tame inflation. And, investors want to know, are they going to stick with the plan? They're going to pivot? Are they going to capitulate? Because here we are, towards about a week or so since that announcement, and the markets are testing their June lows. I mean, we've seen that happen, and will
Right.
that continue on down, or will there be a rally off of these June lows? So anyway, what did Jerome say, Uncle Jerome, since we're among friends? Our listeners are our friends, so we're going to be talking about Uncle Jerome. What did Uncle Jerome say about when they would slow things down? What do they have to see with inflation to really slow down those interest rate hikes?
So this was his best response to that question. Over the coming months, we'll be looking for compelling evidence that inflation is moving down, consistent with the inflation returning to 2%, which is what you said earlier. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate.
So you need to practice in front of the mirror, Jesse, doing your best Uncle Jerome imitation. I think we can work on that. So the listeners really will think that it's Jerome Powell talking, even though Jerome Powell would probably never take the time to join our show. But okay, so enough of that.
So compelling evidence.
Compelling evidence. Okay, compelling evidence. And I think one of those things, and we'll get the jobs report this next Friday, I believe, next Thursday or Friday. We'll get the jobs report, and a typical slowdown would involve employment gains slowing down or actually going in the negative. And that's a clear sign that the economy is slowing down. But the problem's been inflation's still going up. The job market is still strong. Wages are still rising. And that's a lot to unpack about what that means for the economy and stuff. And so
So we're not seeing people get laid off like the traditional.
No, we're not. I mean, we're seeing
in the past.
Some tech companies. I mean, tech companies have been hit the worst. We're seeing some of that. They're freezing hiring. Maybe they're not replacing people as they leave, but they're not on the big hiring binges they were post pandemic.
Right.
And so, this kind of reminds me back to the situation about 40 years ago. We studied this when we studied economics, and we saw, inflation very high, and the Federal Reserve had to embark on an extremely aggressive campaign of interest rate hikes to help lower those price pressures and provide that price stability, right?
So this is the 80s, right? Where
late
double-digit
early
interest
80s.
rates.
And so, but there's a lot that's different about the economy today than it was 40 years ago. Number one, the Fed, in my opinion, is a very different institution. But here we are. We're in a situation where we haven't seen these inflation levels in decades. And what the Fed chairman, the Federal Reserve, said at his press conference last week is, if you can't get inflation under control, you basically cannot have a good economy in any other way.
Okay.
And that's because, Jesse, I mean, the price of high inflation weighs on people in such a way that the Fed has to get inflation under control.
Right, because the average spender really has to make some changes in their budget and their lifestyle, which is going to impact companies' revenues, and it just flows on down.
Well, and Chairman Powell made it clear that they're so committed to doing that they're going to do that even if it causes some pain in other parts of the economy, right? So
real quick,
did you hear anything in his speech about how long he thinks this inflation will last?
Well, you said it could get up to around the 4% range by the end of the year, and
Right,
then
interest rates, yeah.
yeah, interest rates. So then maybe possibly even a touch higher in 2023, and then people think that maybe 2024 we could see the rate lowered.
I don't see why. I mean,
Well, we don't know.
we're involved in quantitative tapering right now, which is the
Hmm.
opposite of quantitative easing. We'll talk later in the show about what England is doing. Seems like the English Federal Reserve, the United Kingdom's Federal Reserve, is capitulating
Hmm.
to this pressure. We're going to talk about whether that influences the United States Federal Reserve. So, what I thought was interesting, Jesse, was if a few months ago the Federal Reserve was kept talking about a soft landing, right?
Yeah, that
That
seems
we
great.
can we can raise interest rates and without causing a recession. And we've had 2 official quarters of negative GDP growth. We'll have the 3rd quarter gross domestic product data. It won't be for 3 or 4 weeks from now, but we'll have it. What if they say it's a 3rd quarter of negative GDP growth? Are they going to confess that, okay, well, it may be a recession? It's kind of hard. This is
Yeah,
different than it has been in the past.
it's very different than the past. Um, Not to get sidetracked here, but going back to what you were saying, how different it is than 40 years ago in terms of the economy and the way that it operates. We've talked on the show a little bit about how a small number of mega cap companies, the fan mags, the fangs, whatever acronym you want to use, depending on companies changing their tickers and whatnot. But if these small amount of companies hold all the weight in the market, how are they getting affected by interest rates? And how does that different than in the past? If they're
Well,
so huge.
it has a negative impact on especially technology companies. And let's continue that conversation after the break, Jesse, because
Okay.
we're up against a deadline here. But folks, you're listening to the Spin Life Well show. We've been talking about inflation, the economy, and everything else, and how we're not supposed to worry about that. But we'll be right back in just a moment.
All right. Welcome back to the Spend Life Well show. I'm Jesse Hamilton, and I'm joined by Mark Trice, Certified Kingdom Advisor. And we have been talking about the Federal Reserve and what's been going on with interest rate hikes and comparing it to what it was like in the 80s and what we're facing now. So, where do you want to begin, Mark?
Well, I think it's a good idea to remind people of our verse for today because a lot of this negative information about the economy and the uncertainty and things. I'm just reminded I was drawn today to
Hmm.
Isaiah 41:10. Don't be afraid, for I'm with you. Don't be discouraged, for I'm your God. I will strengthen you and help you. And I think that we hear all this information about things coming across the television and the radio and things, and you're driving your car right now, and Mark and Jesse are really concerned about the economy. In the end, folks, the most important thing is have a relationship with our Lord and Savior Jesus Christ. He will take care of us in all situations,
Hmm.
and I just want to remind people of that. Uh, with that, so Jesse, I know we talked a lot about the Federal Reserve and the impact of rising interest rates and things. Let's talk about inflation. People may want to know, like, where's it going? We've now had several months, over 12 months of really rapidly rising inflation,
Hmm.
and you might think that it's over with or it's plateauing. Reality is we don't know. There's a lot of different things that could influence and cause inflation to go higher. But we read an interesting article the other day by Matthew Bosler, and it was really trying to get an idea of if you want to know where inflation is heading, the title of the article says, look at rents. Look at rents.
Okay. What does he mean by rent? Does he actually mean rental income for leasing an apartment?
Rental inflation.
Okay.
And so we have to look at that. And as rental inflation tops out, um, that is a good sign that inflation is cooling.
He's saying it's more of a leading indicator.
That's right. That's right. The bad news is it may very well take a while to settle back down. Now, in the last 12 months, that's advanced almost 6% through July rents.
Okay. Mm-hmm.
And it may take a while to settle down to resemble anything pre-coronavirus norms. So rents are a good indicator of the direction that inflation is going. We'll see once the consumer price index data comes out, whether or not that continues through September into the fall.
Okay.
So, if you're the Fed and you're trying to push down on inflation, you sort of have like a hammer, right? The labor market, you have to hammer the labor market. And in a sense, that's what's going to help push shelter inflation down or rental inflation down. As people lose jobs, and we don't want to see people lose their jobs, they're not able to afford rent, or perhaps they will have to move in with others and things. You might see those rises in rent cost go down.
So is this because people are negotiating with their landlords, or they're just losing their jobs and defaulting and leaving, and the
They're
supply
losing
goes
their
up?
jobs and they're having to find cheaper places to rent,
Mm-hmm.
or they move out altogether. So, the CPI data should come out here in a few weeks. So we'll know how it was in September. If we see those starting to shrink a little bit, that could be a good sign that maybe we've peaked when it comes to core inflation. But rents have been a strong indicator. One thing that I have noticed, and we talked about this the other day, Jesse, was we started to see the price for lumber starting to drop. And that could be because there's been a deflation in the demand for
For building.
construction and building and things.
Mm-hmm.
In fact, we saw housing starts were actually kind of hot in August. They rose, but we also saw just this week, we saw data come out saying that real estate prices were starting to fall. And that was the first time that they've fallen in a long time. That could be a combination of things. That could be the cost of borrowing, right? Because interest rates are rising.
Right.
I
That
think we
pushes
saw
mortgage rates up.
a typical 30-year mortgage is now over 6%. And that shoves some people out of the buying market for real estate.
Mm-hmm.
So there's all sorts of different things here. But, rents have always been an important measure of inflation. And that's because what's the biggest chunk of our household budgets, right? It's our
Yeah, it's
mortgage.
our household, and
It's our
it's how
rent.
we pay for the roof over our head.
That's right. That's right. And, rents and so forth. And this is comparable rent. So if you're paying your mortgage, Jesse, that's going into your quote, the rent calculation.
Okay.
But it comprises a little over 30% of the headline consumer price index and about 40% of the core index.
Wow, that's
So,
more than I would think, because
yeah, well, it's such
I
a big
guess
part of our budgets.
some people are spending 40% of their budget on their housing, but a lot of people are spending less than that. So that seems like a pretty hefty number. But I guess that's how they calculate the core index.
That's right. And so, we'll have to watch that in the next couple of weeks to see if that really begins to settle down a little bit. And that could be a sign that rents are going down.
Mm-hmm.
Now, or inflation is topping out. And I wouldn't say it's going down. Now, we've got the double-edged sword. You meant, Jesse, I know you don't remember because you weren't around. But, back in the 80s, there were actually Paul Volcker aggressively raised interest rates in the early 80s and then pulled back. But he pulled back too soon. And we actually went into a second recession when he had to raise rates aggressively again.
Hmm.
And so don't let, a little topping of inflation fool you. There's a number of different things out there that could cause inflation to go up in the coming months. So we just have to be careful about that. In fact, there's actually, Jesse, we were reading about Michael Burry. Michael Burry is
Yeah.
the main character in the movie The Big Short. It's a book. If you never picked it up, I'd probably read the book. I would not watch the movie. It's kind of graphic movie, but if you've never read the book The Big Short, it's a nonfiction book written by Michael Lewis. Michael Lewis is one of my favorite nonfiction financial authors,
Mm-hmm.
and he wrote other books like the obviously The Big Short, but also The Blind Side, which is a great sports movie, a
Yep.
sports book, but The Blind Side. But Michael Burry is founder of Scion Asset Management.
Yep. He's the quirky guy that listens to rock music while he crunches numbers, and he was one of the first people to recognize that there was a major flaw in the housing market.
This is back in the 2007, 2008 market. And
Mhm.
he actually went short against a lot of the financial institutions and banks and things that were lending these crazy things to people that didn't have income, and they're giving
Right.
mortgages, 4 or 5, 6 mortgages to someone that really didn't have a job. And obviously we know the disaster that happened there, but he sees that there's another indicator there that could cause prices to spike and we'll have a price shock. And I don't want to get too technical here on the radio program. We're not meant to be a technical show or anything, but there's something called the money supply. All right.
Mhm.
And M2 for short, for those of you that remember your high school or college economics class,
Right.
if you're a business student. But the money supply here, um, if we see rising velocity and a declining money supply, which we've been seeing the declining money supply, but we see rising velocity. That's the transactions that a dollar goes around the bend a couple of different times. Okay,
Mhm.
and so some people are saying that, or he's saying that two factors there might be a precursor to higher inflation. Now, there's some other big name folks that have been saying, "Hey, we're at risk of having stagflation or deflation, if you will."
Right.
But that's kind of outdated, I think, at this point. Elon Musk was one of them, and then Kathy Wood with ARK Investment Management. So, for those of you that are curious, um, quantitative tapering should start pushing the money supply down, but we're starting to see a tick up in velocity. And it's in 1978 to 1979, rising velocity, going back those 40 plus years, that trumped over the falling money supply, and that drove inflation even higher and higher.
Mhm.
Will we see a repeat of that? Well, I don't know. But it's interesting to look at, it's something to watch. No one has a crystal ball that can predict what will happen. But, Elon
Even
Musk,
Michael Burry, one of the
even Michael
smartest,
Burry, he's a brilliant guy.
brilliant guy.
I never could crunch numbers while listening to heavy metal rock music. But, Elon Musk said that, hey, early this month, he said that the Federal Reserve should actually cut interest rates, and warning that a major hike might risk deflation. And he was responding to Kathy Wood, and she's saying that deflation is in the pipeline. Well, okay. No one really knows with this. I do know that both of them happen to own or manage types of securities that would benefit very much so from a
Yes, they
drop
would.
in interest rates. Okay.
They all have a lot of motivations, and they also, all three of them have had absolute home runs in the past that they're looking for their next opportunity to make a
Yeah.
choice before nobody else knows.
So is there any bias there between,
Probably.
all three of these people? Maybe so. And who knows? Mr. Big Short, Michael Burry, might have his own investments, right?
Right.
It's so nebulous, and it's so careful that when you listen to these talking heads, whether they're a Kathy Wood or an Elon Musk or whoever, you have to ask the question: what's their interest in this?
Mhm.
What's their angle for this situation? So one thing else, Jesse, that we've been watching this week, and it happened actually today, the Bank of England announced that they were going to start buying bonds to
Right, which is
stop.
not what everybody else across the world is doing.
No, there's
I
two big
don't.
things that have happened in England in the last week.
Right.
The announcing of buying bonds, which in effect puts liquidity in the markets, which we don't need. That was the problem that we had with
Mhm.
inflation in the first place. And they also announced last weekend that they're going to have a large set of government tax cuts. And those tax cuts sent the borrowing cost of bonds skyrocketing.
Yeah. Huge, huge changes in a matter of moments. But like I said earlier, this is the opposite of what the Federal Reserve is doing, and what other major countries and players around the European Union are not doing this. So they're actually pumping more liquidity into the market.
Yeah. So, they've announced that they're going to try to delay this for a few weeks before they actually start buying. Markets kind of reacted to that because the 10-year Treasury or the 2-year Treasury hit over 4% this week. The 10-year Treasury was not close behind. We're talking about the U.S. Treasuries and so forth. But it's really it's a conundrum, Jesse, because this is the opposite of what the Federal Reserve is saying that they're doing here in the U.S. But
Does it have to do with the fact that the U.S. dollar keeps rising and rising?
well,
And
that's
for the
part of
first
it.
time in a long time, the British pound dropped below one for the U.S. dollar.
Right, and that hasn't happened in a long time. And
Yeah.
so a lot of international currencies are getting the pound is getting pounded, right? The sterling is getting pounded. And so yeah, that could be part of it. They're trying to stabilize their own currencies and things, so that could be the response, but it's going to have a ripple effect around the world markets, and we have to watch that very closely because that's kind of a U-turn, but it's a U-turn that's saying that, hey, the central bank in the United Kingdom has a deep concern about their financial markets.
Mm.
When they announced those tax cut plans, it really spooked investors, and that sparked a steep sell-off in the pound, and it really caused a lot of volatility in the debt markets. And that government stimulus that the United Kingdom put out was really at odds with the central bank, which has been trying to tame inflation. I mean,
Right.
it makes no sense. Why don't they talk together? Why don't they say, "Hey, let's do this or that"? But it's like they're not even communicating.
So does this mean that mortgages are going to get a lot cheaper in England if they're if they're buying bonds back? Then
It could,
that's what happened in the U.S. after COVID.
but that's going to stimulate buying of real estate,
Right.
which we're trying to cool that off a little bit
Mm-hmm.
because that's such a big chunk of the consumer price index. Anyway, it makes my head spin. So in fact, even after they announced that they were going to be doing the bond sales and so forth, a number of banks in the United Kingdom actually slowed down or stopped releasing new mortgages because they just can't handle those whipsaws in bond yields. And so,
They're just losing too much money when that
yeah,
happens.
and it's dangerous. So we'll have to watch this and see, and we'll keep you informed about what's going on. Jesse, we're getting to the end of our second segment. We're going to need to take a break here in just a moment. But when we come back, folks, we're going to go over what's been happening in the market year to date. How's this impacting your portfolio, and the need for getting good quality advice. Folks, you are listening to the Spin Life Wealth Show. I'm Certified Kingdom Advisor Mark Trice. You've been talking with Jesse Hamilton and I have been talking about the economy and markets, bonds, rates, etc. We will be right back in just a moment. Stay tuned. Welcome back, everyone. You're listening to the Spin Life Wealth Show. I'm Certified Kingdom Advisor Mark Trice. I'm joined by Jesse Hamilton, and we've been talking about all the news in the economy and what it means for your portfolio. Today's scripture verse is from Isaiah 41:10, I believe, and that says that don't be afraid, for I am with you. Don't be discouraged, for I am your God. I will strengthen you and help you, and I will hold you up with my victorious right hand. Reassuring words from scripture as we talk about finances. And we have to remember, if we believe that God owns it all and that God's got it all, then we don't need to worry about things, what's going on in the economy and things of that nature. But we do need to educate ourselves, inform ourselves, and take action when necessary, because we're called to be good and faithful stewards of what we've been blessed with. So
Mhm.
anyway, with that, Jesse, let's get a little update on the markets and how things are going year to date.
Sure. So we'll start off as always with the S&P 500. These are the 500 largest companies in the US. It's a popular index to look at for equities, and that specific index is down 23.4%. A lot of people invest in these things. You may or may not know it, but it's probably a part of your 401k or your investment account somewhere. Very popular to invest in that index.
Because
Next,
it's large cap
yeah, it's large
companies.
cap. They're
I
supposed to
guarantee.
be big,
Well,
healthy companies.
it's almost every 401k plan. There is a large cap growth fund,
Hmm.
and this is the S&P 500, or a good component of it, or large cap growth stocks.
Right.
Now, don't let that fool you. Does not mean that they always go up, as we've seen here, as the data this show minus 23% year to date.
So next is the Nasdaq, which is an index of technology-focused companies, and they're a little bit more volatile this year. Year to date, minus 30.7,
30%. Why are losses so important to try to avoid, Jesse?
because it's very challenging to get back to where you started from because you have less to work with.
You have less to work with, and in reality, if I lose 10%, I have to gain 11% with less money just to make it back to where I am.
Hmm.
When it's 50%, I have to gain back 100% in order to get back to where I was.
Right.
We're down over 30% in the NASDAQ. What about the NYSE? Because we've officially, the other two indexes we talked about, Jesse, we were already in bear markets. We've been in bear markets for some time,
Right.
but we officially crossed the line and are in a bear
Correct.
market territory in the Dow Jones, or the Dow 30, NYSE,
Hmm.
the NYSE Composite Index, which is down what year to date?
21%.
21%. So we are in the bear. This is a good time for Jessica to add our bear roar, or growl, because we are in a bear in all three major indexes.
Yep. And you probably also own a little bit of small cap. So the Russell 2000 is the most popular small cap index. That's down 25.9.
25.9%. And then finally, what about those long-term treasuries?
Right.
Hang
Long
on
term.
hang on to your steering wheel, folks, if you're in the car, or stabilize yourself, find a good
Yes.
place to sit down, because bonds are supposed to be the safe haven when the markets goes bad. All right. So
Correct.
how are
And
they doing?
the year to date performance on the long term treasury index minus 31.8.
Oh, this requires an even louder scream of terror. Okay. Bonds are supposed to be the safe place. In fact, all the financial news, all the financial talking heads, all the financial advisors out there that you listen to are always tell you, when stocks are bad, and you want to de-risk, add more bonds. That doesn't work in this environment.
Mm-mm.
We are at the end of a 40-year bull market in bonds, and we've gone down in the longer term treasuries over 30% year to date. Now, that is a big move, and it is crushing to those of you that are owning that typical 60-40 portfolio. In fact, there's so many articles out right now, Jesse, that talk about, is the 60-40 portfolio dead? And it didn't happen just this year. This has been going on for a couple of years.
Right.
And you need to look at your statements. They're coming out here in the next week or so. Your quarterly statements for your 401k, the statements for your brokerage accounts and investment accounts. You need to look at those, and you need to take action.
Right.
What that action is, Jesse, depends on each individual's personal preferences and objectives and
Exactly.
investment profile. But
Yeah. So don't be afraid, is what we're trying to say, of looking at your statement. Pull it out,
yeah,
open the envelope, and look at it, and see what it says, and actually look at what you're holding. If it's confusing to you, the internet is always a great resource, or give us a call. We'd love to talk to you about it.
Yeah, there's two ways folks can contact. In fact, for listeners of this program only, we are offering a complimentary second opinion on your portfolio.
Mm-hmm.
This will not cost you a dime. We will give you some opinions about what we think is going on with your portfolio. We will send you, if you contact us, we'll send you a little risk questionnaire, and you can take that, send us your portfolio. We'll analyze it for you, off complimentary, no cost, and just give you some pointers. And if we can help you make those changes, we'll be happy to do that if it's appropriate. But folks, it's now is the time is not the time to bury our heads in the sand. I'm reminded to conversations that I have with clients after 2008. I asked them what they did during that time, and without exception, most people said, "I didn't even open the envelope. I don't want to know how bad it is." Well, that's not being a good steward, Jesse. That's
Mm-mm.
not taking control of the situation and making sure that you are trying to protect your wealth and also try to make it grow over time. Now, this bear market will eventually go away. We don't know if the lows in the market right now, we're certainly testing the June lows from earlier this year. If the June low is the low and that's the bottom of the market,
Mm-hmm.
or it's a low and there's more
Yeah.
downside risk to go, why take a chance and not talk to someone about your portfolio? If you have an advisor, call them up. What's going on? How are we making adjustments to protect our wealth? And if they give you the typical language, if they say, "Don't worry, it'll come back," give us a call.
Mm-hmm.
You can reach us at 254-282-0495, 254-282-0495, or just send us a message at radio@spendlifewell.com. It's so easy. It will take you maybe all of 15 minutes of time, and you'll just get a sanity check on your portfolio. And if we can help you, we will. If not, we'll give you some advice and send you on your way. We'll give you some questions for you to talk to your advisor about so that they
Mm-hmm.
can help you. We're not trying to drum up business here, folks. We're trying to help people preserve their wealth. And I hope you'll take advantage of that. radio@spendlifewell.com, or give us a call at 254-282-0495. And you can actually text us at that number. Is that right, Jesse?
Correct. Yeah. We'll try to respond.
All right. So that's the market update. Hang on to your hats. We were watching a presentation the other day, and it was basically a picture of a roller coaster, and someone was just about to go over the top of the hill, and you know how they had that terrified look.
Mm-hmm.
We're afraid a lot of people are maybe that way. So get some advice. Talk to a professional financial advisor.
Right.
So Jesse, it's that time again. We haven't played this game in a long time. What's that segment called?
It's called Should I Do That?, where we look at financial advice from the people on the major internet sources, whether that's, Bloomberg, the Wall Street Journal.
Should I do that?
The places people are reading, and there's lots of advice out there. So we are here to discuss. We found an article called Bad Advice from Financial Advisors, which immediately grabbed our attention. So let's dive into this. The first piece of bad advice is a financial services firm in Ohio that said that their investments have little to no risk.
Oh.
And that is a major red flag. And
why
so,
is
yes.
that so, Jesse? Because, I hear that all the time, especially from folks that come to talk to us and say they can never lose any money.
Mm-hmm.
And that's kind of false. Investments,
It really
all investing has risk.
Right.
Even not doing anything, Jesse, not doing anything and leaving your money in the mattress has risk.
Right.
There's no free lunch. There's no risk investment out there. I don't care what these salespeople are telling you. Every investment has risk.
Mm-hmm.
They're just not disclosing what that risk is.
Right.
So,
So their rebuttal to this first bad advice is obviously saying that all investing involves risks, which is what you just said. In addition, you should always mind your own personal investments of how risky they are and how they apply to you individually.
yeah. So you have to realize that there's multiple levels of risk on everything, like even not doing anything. And
Mm-hmm.
any quote advisor or salesperson that tries to minimize that risk is just trying to sell you something. So
Mm-hmm.
be careful. Be careful.
Right.
If your advisor says anything that minimizes the inherent risk of investing, what do? Walk away.
Walk away.
Walk away. Uh, and look for other options or get a second opinion.
Mm-hmm.
Um, and do it that way. Okay.
So
What's the next
you're
piece
gonna
of?
like this one, Mark. So the next
Okay.
one is the next piece of bad advice is shift to bond-based funds as you approach retirement.
Oh, they were writing this for me. They were writing for this for me, folks. All right. Well, let's see. You're investing for the long term, right?
Mm-hmm.
And a lot of people make this mistake. They thought, well, I have to get a whole lot more conservative because I'm retiring. Most people retire in the early 60s.
Right.
What's the average lifespan for a woman? It's like 82.
80. Yeah, I
Okay.
was gonna say a little more, but I guess it's 82.
And I had three great aunts. Okay. 3 great aunts. They all lived to at least 102, and 2 of them lived to be 104. And the one that lived the longest, Jesse, you know what she said her secret to longevity was?
What is it?
She dipped a little snuff every day. Aunt Pearl. Aunt Pearl said, "I dip a little snuff every day, and that makes me live longer." Well, anyway, that's no one cares about that, right? And I don't recommend dipping or tobacco products, but anyway. So a lot of people say you should get more conservative when you retire, but you may have 20, 30, even longer years uh, in retirement. So
Right.
why do you
That's
want
a
to
lot
get
of time.
yeah, and why do you get more conservative? Maybe we need to reallocate things and handle things differently, but that doesn't automatically mean that you should be more conservative. If this year's proved anything at all, that bonds are not safe 100% of the time. And so and inflation can really eat away at bonds. Rising interest rates can really destroy bonds. We are in that environment now.
Right.
So if you're holding bonds and you think you've got a 60-40 portfolio, or worse, you've got a quote balanced portfolio, folks, you better open up your statements. You're investing for the long term, even when you're in retirement.
Right.
I think the mentality is, Jesse, that when I stop working, I should stop investing.
Some people think that.
And we're not cashing out our 401k and stuffing in our mattress. We have to stay ahead of inflation. We have to do things to generate income.
Mm-hmm.
There's so much more. So absolutely. Is this bad advice to shift to bonds as you approach retirement? Yes, it is bad advice. Maybe it's right for you, but in most cases, you have to be very careful. Let's
So
do
you're
one more.
okay.
Let's do two more of these, Jesse, because I'd like to take a listener question.
The bad advice is choose actively managed funds. What does that
Okay.
what does that mean?
Well, actively managed funds have advisors that claim they're doing a lot more than ones that are passively managed.
Mm-hmm.
They typically have higher fees and things like that. You should really choose the management style that works for you.
Right.
And let's do this last one because this is one that people think, especially in Austin, Texas, where real estate prices have gone up.
Yes. It's that your home is an investment.
My home is an investment. No, your home is not an investment. Your home is a place you live, and you should not be part of your investment strategy. Jesse, can you go down to the 7-Eleven and cash in your home?
It's not that
No.
easy.
So it's really, your house is really kind of a liability because you owe taxes and everything else. So
Yeah, you also
anyway,
have to live in it.
yeah, and these are interesting questions. Just be careful about the advice that you get. Jesse, we're coming up on the end of the program. I know we had
Right.
listener questions, so we'll make sure we cover that next week. But this has been a really exciting program. I know we covered a lot of maybe negative information, but always remember God is in control of our lives, our situation, and in the end, we know who wins. So
Right.
with that, everyone, from Jesse and I, thank you very much. Have a great week. God bless.